Welcome to this explainer of the June 2026 executive briefing. Let's jump right in, because today we're unpacking a massive disconnect. We're looking at the widening gap between headline economic numbers, which honestly look absolutely fantastic on paper, and the volatile, churning reality that's hiding just beneath the surface. Okay, so take a look at this. The Dow hitting 52,000? At first glance, that looks like pure economic triumph, right? But that historic headline is actually masking a really violent sectoral rotation. The critical information technology sector didn't just stall out. It literally suffered a 2.3% drop. It's the classic illusion of stability. Those top-level numbers, they're totally hiding the real story.
To make sense of this complex landscape, we're going to break this explainer down into four key pillars. First, the Dow 52K illusion. Second, tech's trillion-dollar shakeup. Third, global risks and realignments. And finally, the domestic reality check.
Let's start with Section 1, the Dow 52K illusion, surface strength versus consumer reality.
What's absolutely fascinating here is the sheer divergence happening right under our noses. So while financials are leading the charge upward and giving us that shiny 52,000 headline, the broader context is, well, it's a lot more strained. If you peek at the underlying metrics, housing starts have fallen sharply, import prices are ticking up, and those fading tax refunds, they're actively eating into whatever wage growth the average consumer might actually be seeing right now.
And you can see that strain really clearly in everyday spending. While the broad FactSet consensus was expecting retail sales to grow by 0.6% for May, the Chicago Fed estimates, which exclude autos, actually show a contraction of 0.2%. This is a huge signal. It points to some serious underlying weakness in basic, everyday purchases.
But here is where it gets kind of wild. Contradicting that everyday weakness is a massive behavioral shift. People might be cutting back on everyday retail, sure, but they are aggressively funding premium, unreplicable out-of-home experiences. Get this, the summer box office is pacing 11% higher year over year. IMAX just hit all-time stock highs, driven by massive hauls from major releases globally. So the consumer definitely isn't dead. They're just getting incredibly picky about exactly where they deploy their cash.
Moving right along to Section 2, tech's trillion-dollar shakeup, hardware winners versus megacaps.
So that insatiable demand for AI we keep hearing about, it is violently shaking up the tech hierarchy right now. We've got fresh trillion-dollar entrants like Broadcom, Micron, and AMD surging on this massive wave of relentless memory chip shortages. But on the flip side, the once untouchable megacaps, your NVIDIAs, Alphabets, Microsofts, and Amazons, they're looking downright exhausted. We're talking steep pullbacks of 6 to 8% in just a single month. It's a massive rotation out of what a lot of fund managers are now calling overcrowded trades.
Now, the crucial point here really comes down to scale. $2.66 trillion. Just take a second to process that number. That is the staggering new valuation SpaceX achieved, and they pulled it off in just 3 days. 3 days! And they did it completely independent of that broader tech sector sell-off we were just looking at.
SpaceX's breathtaking ascent literally bypassed Amazon entirely. Using an $86 billion war chest, they executed a massive $60 billion all-stock acquisition of Cursor for enterprise AI tools. By cementing their place at the summit like this, they made a really bold play for AI dominance that totally ignored the gravitational pull of the rest of the market.
Now, complicating all of this rapid growth is a very deep regulatory standoff over national cybersecurity. We've got a major policy debate unfolding here. On one hand, the Trump administration fears that next-generation AI software could enable global cyber havoc, and they're arguing it needs to be kept tightly under wraps for national security reasons. On the other side of the aisle, you have Anthropic and the broader Silicon Valley ecosystem arguing that releasing the software publicly is actually inherently safer. So this is an intense, months-long spat between the government and leading developers over open versus closed AI systems. And honestly, it's a debate that's going to define the future of the entire industry.
That brings us to Section 3, global risks and realignments, geopolitical spillovers.
1 million. That staggering number represents the nearly 1 million people punished in 2025 under Beijing's anti-corruption dragnet. It's the highest number on record, marking a really massive internal shift.
And listen, this is definitely not just an internal political matter. It has huge, direct, global market implications. Beijing's campaign has shifted focus away from economic crimes and pivoted toward absolute political loyalty tests. This intense new regulatory reality is creating massive corporate spillovers. It's actively pressuring and damaging the market operations of Western brands in the region. For instance, we've already seen major players like BMW having to cut their guidance, specifically because of these intense Chinese market pressures.
Shifting gears to global energy, we see a totally perfect example of this illusion of stability. The consensus trade saw the US-Iran peace deal, felt the geopolitical relief, and then basically sold off oil by 16% over 5 sessions. But institutional contrarians, they looked at the exact same event and saw a massive buy signal. Why? Because US stockpiles are literally at their lowest levels in 40 years. So that geopolitical relief is simply masking a multi-year lack of energy investment that governments are going to have to aggressively refill very, very soon.
Finally, let's look at Section 4, the domestic reality check, defense, and the fiscal cliff. To rebuild severely depleted munitions, the White House actually just invoked the Cold War-era Defense Production Act. The catalyst here is a super fragile supply chain, which is now forcing these unprecedented, high-volume partnerships. Think teaming up General Motors' massive scale with Lockheed Martin's specific expertise. But look, despite these drastic measures to replace long-range missiles, the ultimate risk factor remains a very precarious 6-year timeline just to replace our existing stockpiles. 6 years is a long time in defense.
But perhaps the absolute most urgent, unavoidable domestic reality we're facing is the Social Security Trust Fund depletion. Guys, this is no longer a problem for the distant future. Think about this timeline. 16 years ago, payroll taxes stopped covering expenses. 5 years ago, interest income stopped preventing shrinkage. Last year alone, reserves shrank by $200 billion down to $2.34 trillion. And by Q4 2032, we hit the cliff. The trust fund runs completely dry, which triggers automatic benefit cuts. Avoiding this requires immediate Treasury intervention right now, today, which of course threatens to hike taxes, raise mortgage rates, and disrupt bond portfolios across the board.
So, bringing it all together, we've got 4 specific macro cross-currents defining this upcoming quarter. You have the Fed's monetary policy shifts, the trillion-dollar tech valuation shakeup, the contrarian commodities rebuild, and of course, those looming fiscal and supply chain realities right here at home.
As we wrap up this explainer, the critical thought I want to leave you with is this. When surface stability, like a flashy, record-breaking Dow 52K, masks such violent structural cross-currents beneath the surface, how is your portfolio truly positioned to survive the hidden reality? Thanks for learning with me today, and keep your eyes on the data beneath the headlines.